In 2026, we are sitting inside one of the most significant financial windows of opportunity that any living generation has ever experienced. Not because of some hot stock tip, not because of a cryptocurrency that's about to explode, but because of a slow-moving, mathematically inevitable trillion-dollar shift that most people are completely ignoring. And the people who pay attention, the ones who act, could be looking back 10 or 20 years from now as millionaires. The ones who don't will be looking back, wondering why they missed it. Stay with me because by the end of this video, you are going to understand exactly what is happening, why it matters, and what you can actually do about it starting today. Let me take you back to a moment in history first, because understanding the past is the only way to understand what is possible right now. It is March of 2009. The global financial system has basically just had a heart attack. Lehman Brothers collapsed 6 months earlier. Retirement accounts have been cut in half. Your neighbors are losing their homes. Every single news channel is running specials about the end of capitalism. The unemployment rate is skyrocketing. People are genuinely terrified. The S&P 500, which tracks the largest companies in America, has fallen to around 676 points. To put that in perspective, the same index would later cross 7,000 points in January of 2026. That is more than a tenfold increase from that terrifying low. Now here's the thing. In the middle of all that fear, a relatively small number of ordinary people did something that looked absolutely insane at the time. They invested. Not hedge fund managers, not Wall Street elites with insider information, regular people, teachers, nurses, construction workers, accountants, people who had been quietly saving money and who understood one simple, powerful truth about how markets work. Fear is not a fact. Fear is a feeling. And when fear takes over markets, prices fall way below what they are actually worth. Those people who held their nerve and bought during the 2009 crash saw extraordinary results. A $10,000 investment in the S&P 500 made at that point grew to over $80,000 by the time the next decade was done. That is not gambling. That is pattern recognition combined with patience. And this was not the first time this happened. Go back to the dot-com crash in 2000. The NASDAQ fell more than 75% from its peak. Everyone declared that technology was a fad and the internet was overrated. Companies like Amazon dropped from $85 a share to just $6. People who bought during that crash and held saw gains that are almost incomprehensible today. Amazon shares that were sitting at $6 eventually climbed to over $3,000. That is a gain of roughly 50,000% for anyone patient enough to hold through the chaos. Go back further to 1987, Black Monday, when the market dropped 22% in a single day. People were convinced it was the start of another Great Depression. The market fully recovered within 2 years and doubled within 5. Every single time throughout history, panic has been followed by recovery, and recovery has been followed by new all-time highs. The pattern is not a coincidence. It is human psychology playing out over and over again in predictable cycles. Markets are driven by two emotions above everything else, fear and greed. When things are great, greed takes over and prices inflate beyond what they are really worth. Then something shocks the system and fear takes over. Prices collapse. But the actual value of great companies does not evaporate overnight. When Apple was trading at $12 a share in 2009, people were still buying iPhones. The company was still generating billions in revenue. The fear had simply disconnected the price from the reality. Warren Buffett built one of the greatest fortunes in history by exploiting exactly this disconnect. Buy when others are fearful. That is not just a quote. It is a strategy backed by a century of market data. And it has created more millionaires than nearly any other approach in existence. Now, let us talk about what is happening right now, because this is where it gets genuinely exciting and where most people are asleep at the wheel. We are currently in early 2026, and the financial landscape is a complicated mix of signals. Markets have experienced significant volatility over the past couple of years. Interest rates have remained elevated for an extended period. Inflation has been persistent. Consumer confidence is shaky. Growth has been slowing in certain sectors. Technology stocks that were trading at wild multiples in 2021 have corrected hard, with many growth companies down 50, 60, even 70% from their peaks. Some of those companies were garbage. They deserve to fall. But some of them have real revenue, real products, and real futures. And they got swept up in the broader fear, just like Apple did in 2009. This is the kind of environment where wealth is created for people who are paying attention. But here's the layer most people completely miss. Underneath the market volatility, something even bigger is unfolding, something that has no equivalent in modern economic history. According to research from Cerulli Associates released in 2025, approximately $124 trillion in assets will change hands over the next 2 decades. $124 trillion. That number exceeds the entire annual economic output of every country on Earth combined. It is more than 5 times the current United States national debt. And it is about to start moving through the economy at an accelerating pace. What is driving this? Baby boomers, the generation born between 1946 and 1964, currently control roughly 52% of all wealth in the United States. That is approximately $78 trillion concentrated in a single generation. The youngest boomers are turning 62 this year. The oldest are approaching 80. Over the next 25 years, this enormous stockpile of wealth will transfer to their children, grandchildren, and charities. Cerulli estimates that Generation X stands to inherit approximately $39 trillion. Millennials will receive roughly $46 trillion. Even Gen Z will start seeing significant wealth flow their way as the transfer accelerates into the 2030s and 2040s. This is what researchers are calling the Great Wealth Transfer, and it is the largest movement of financial assets in human history. To understand the scale of what happens when that kind of money starts moving, think about what occurred after World War II. Returning soldiers used the GI Bill to buy homes, start businesses, and create the American middle class. That wealth creation event built the prosperity that defined an entire generation and ultimately produced the baby boomers themselves. We are now watching that same story play out in reverse and at a scale that dwarfs anything that came before. And what does history tell us happens when trillions of dollars start flooding through an economy? It creates waves of opportunity across asset classes, real estate markets, industries, and investment vehicles. The people who are positioned correctly before those waves hit are the ones who build serious wealth. Now look at what has already happened over the past 15 years just to understand the trajectory. In 2010, there were approximately 8.4 million millionaire households in the United States. By the end of 2024, that number had grown to nearly 24 million. 15 million new millionaire households in just 14 years. The United States was adding more than 1,000 new millionaires every single day in 2024, according to UBS. And the majority of those new millionaires were not people who sold tech startups or received massive bonuses. They were regular people who stayed invested in broad market index funds through their retirement accounts while everyone around them panicked at every dip, every headline, every crisis. The S&P 500 crossed 6,000 points in late 2024 and then crossed 7,000 in January of 2026. Someone who just kept adding to a basic index fund through every scary headline since 2009, through the European debt crisis, through trade war fears, through a global pandemic, through inflation spikes, through interest rate hikes. That person is sitting on genuinely life-changing money right now. Not because they were a genius, because they were consistent and patient and they understood that short-term fear does not cancel out long-term value. So what does this mean practically for someone watching this video today? Let me be direct with you. I want to talk about a few concrete things you can do right now, because information without action is just entertainment. First, understand that the great wealth transfer is already happening. The oldest boomers are in their late 70s right now, and assets are already beginning to move between generations. Waiting for a better moment to get positioned is a strategy that history consistently punishes. The best time to be invested is before the capital flows accelerate, not after they are obvious. Second, maximize your tax-advantaged accounts before anything else. For 2026, you can contribute up to $23,500 to a 401k, with an additional $7,500 available if you are 50 or older. Max out your IRA. Use a health savings account if you qualify. These accounts are your single most powerful wealth building tools because your money compounds without being taxed every year along the way. Third, stop trying to pick individual winners and just own everything through broad market exposure. Buy total market index funds or an S&P 500 fund and keep it simple. When you buy a total market fund or an S&P 500 fund, you are not betting on one company or one sector. You are betting on the entire American economy growing over time, which it has done through every crisis, war, recession, and panic attack in the last 100 years. Most professional fund managers with teams of analysts cannot consistently beat a basic index fund over a 10-year period. The evidence on this is overwhelming, and yet people still try to outsmart the data. Stop making it complicated. Fourth, use dollar cost averaging if you are investing a larger sum so you are not emotionally exposed to a single entry point. Do not dump everything in at once. Divide it into chunks and invest steadily over several months to reduce timing risk. If the market drops further, your later investments buy in at even better prices. If the market rises, you still captured some of that gain early. This approach removes the impossible pressure of timing the perfect moment and replaces it with discipline. Fifth, build cash reserves for moments of dislocation. Because volatility is not a bug in markets, it is a feature. The wealth transfer will create turbulence in markets as trillions of dollars shift and get redeployed by heirs with different preferences than their parents. Those turbulent moments are when the real opportunities show up, and having cash ready when everyone else is panicking changes everything. Let me also address the risk conversation directly, because I want to be honest with you about what investing actually involves. Investing always carries risk. Markets can stay down longer than you expect. Individual companies can fail completely. The economy might face challenges that nobody predicted. And volatility can test your conviction in ways you cannot simulate in advance. This is precisely why your investment time horizon matters so much more than your entry price. If you might need money in the next 1 or 2 years, it should not be in the stock market. Period. Keep that money safe in cash or short-term savings instruments so you are not forced to sell during a downturn. The money that you invest should be money you genuinely do not need for at least 5 years, preferably a decade or longer. Long-term investing has a fundamentally different risk profile than short-term speculation, and that distinction is everything. Here is something that most financial content never talks about honestly, and it deserves attention. The psychological challenge of investing through scary moments is genuinely hard, even for people who understand the history. Knowing the pattern and believing that markets recover does not eliminate the emotional impact of watching your account balance fall daily. The people who built wealth through previous crashes were not immune to fear. They felt it too. What they had was a plan they had committed to in advance, before the panic hit and before emotions overwhelmed logic. The plan was their anchor. It guided their behavior when headlines were screaming and everyone else was selling. Make your plan now. While things are relatively calm and rational, thought is still accessible. Decide what you will buy, how much you will invest, and what signals you will look for when volatility increases. Write it down. Commit to it. And then when fear comes, because it will come, you already have your answer prepared. Let me give you the big picture one more time so it lands clearly in your mind. Over the next 25 years, $124 trillion is going to move through this economy. That capital will flow into investments, businesses, real estate, and markets, creating ripples of opportunity across asset classes. The markets have already been on a historic run, with the S&P 500 crossing 7,000 in January 2026. 15 million new millionaire households have been created in just the last 14 years. And the largest intergenerational wealth transfer in human history is just getting started. The conditions for regular people to build serious wealth over the next 2 decades are arguably the best they have been in a generation. People who invested in 2009 looked brilliant in hindsight, but in the moment they looked irrational to everyone around them. People who stayed invested through the COVID crash of 2020, who watched the market drop 34% in 23 days and did not sell, looked reckless at the time. They looked smart within a year as markets recovered and pushed to new highs. History is going to look back at this period in the mid-2020s, with the great wealth transfer just beginning to accelerate. It is going to say that this was the moment when the conditions aligned again for ordinary people to build extraordinary wealth. The question is always the same. Were you one of the people who recognized what was happening and positioned yourself accordingly? Or were you one of the people who watched from the sidelines and wished you had acted sooner? The data is clear. The pattern is documented. The opportunity is real for those who choose to engage with it. Every generation gets a handful of moments like this, where conditions align to make extraordinary outcomes possible for ordinary people. This is one of those moments, and you now understand what is happening beneath the surface. You know the history. You know the scale of what is coming. You know the steps you can take today. What you do next is entirely up to you and will shape the financial trajectory of your life. If this gave you a new perspective on what is possible financially, hit that subscribe button and share this with someone who needs to hear it. And remember, I'm not a financial advisor. This video is for educational purposes only, and your results depend on your own decisions and circumstances. But knowledge is the first step toward action. And today, you took it.